Good morning from the Chicago Board of Trade building here in the financial district of Chicago. It is 8 a.m. My time on Wednesday, the 22nd of September, 2021. This is episode number 2078. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, looking at our pre-market summary sheet. Thank you for the sound check. I just never know what sound is like. In our pre-market summary sheet this morning, we see that we have a mild risk-on sentiment, except in Europe, where they're definitely putting on the risk this morning. The only major news out of Europe is that the ECB's non-monetary policy meeting took place, and there's a little bit of chatter on that. But overall, the market is taking a risk posture again as it perceives, and again, I disclaim and I warn that the media in general and many market participants like to package news events and what's driving the market into a nice little neat thing, which isn't realistic. But the market's attributing this push higher, as it says there, that the Chinese property market concerns are cooling. Evergrande is able to meet its debt obligations and payments, is what it says. Market really spiked down yesterday and then ended up rallying. The other thing that's got the market on jitters is the FOMC decision that's coming today. Being as it is an FOMC day, you have to take that into consideration in terms of the types of risk that you're going to take today, because it is likely, the higher time frame, or what we call the OTF, or the other time frame, which is whatever time frame is different than ours. So we are the OTF's OTF. Those guys are likely to take a posture, whatever that posture is this morning, either a hedging posture, risk off, whatever it is. Futures are a very important hedge tool, high capital efficiency tool. And they may take those positions and just stand by. So we often see the Fed day goes sideways until the decision comes out at 2 p.m. So today we have several key numbers. At 10 a.m. Eastern U.S. time, consumer confidence comes out, the flash number for September. We also get existing home sales. We've seen softening in home sales, although the numbers yesterday show the opposite. We get the crude oil inventories, the EIA crude oil inventories for those trading energies. At 10:30 Eastern, we get the Fed rate decision at 2 p.m. And what's important with the Fed rate decision here is the dot plot. The market is not expecting interest rates to change. We expect those to remain at 25 basis points, the discount rate. But people are looking at the dot plot. If you don't know what the dot plot is, you probably should look at it, look that up. But essentially, it is a forecast of the votes on where the various FOMC committee members stand in terms of interest rates over the next couple of years or whatever. So the expectation is the FOMC will not raise interest this year. There will be one raise next year, and then maybe two in 2023. If you have not listened to Jeff Snyder's talk at Convergent Trading, an interview that I did with him on a webcast last Thursday, if you have not listened to that, I strongly encourage you to go listen to it. He is one of the great global macro minds out there, and he's very detached from an agenda, and his view on what the FOMC does is really much more about managing expectations rather than doing things. So if the dot plot is way off today, what you're probably going to hear at 2:30 at 2:30 in the press conference from Fed's chair Colin Powell, if the dot plot does not meet the market's expectations and the market responds in a negative way, what he's likely to do is just show up and tell everybody how the dot plot is not important and it's not relevant, to try to quell that fear. But he'll refer to the dot plot as a kind of a consensus tool or whatever in other circumstances. So again, his job is to make things appear a certain way. So following the discussion with Jeff Snyder, my perspective on how to look at these FOMC days has definitely dramatically changed, but I'm not a macro trader. I'm still looking at how the market is going to respond. Does it give me setups? Do we see trapped shorts or longs? Do we see imbalances in the order flow? And that's basically what I'm trading. So that's where we stand. My point being, you're going to hear a lot about the Fed today. As a trader, just put that in perspective, and I'm trying to give you one perspective that you can either adopt or ignore. But in general, it shouldn't impact how you manage risk and how you trade today. Just know that going into probably somewhere around the European close, which is at 11:30 Eastern, things tend to go really sideways, and it seems like the interns take over the major trading desks or something. It starts to do weird stuff, and I would suggest you go for a walk during that period or whatever. As far as how things are shaped, the U.S. markets are in the double-digit basis point increase today. As you can see in front of you, 52 basis points for the NASDAQ, 68 basis points higher than the S&P. The Russell's 81 basis points higher, but Europe is in the triple-digit basis point higher this morning, 1.39% in the Euro stocks and 108 basis points for the DAX. Crude pushing higher, and again, crude gets its inventory reports today. Metals have been pretty much choppy and sideways. Copper's picking up a little bit, and then we see Bitcoin and Bitcoin sideways. Ether is actually a little bit higher versus the close yesterday on the CME. We're using the CME contract to have a proxy here because it has a start and an end. But Ether is actually weakish. It is positive today, but remember it was at 3,800 or so just a couple weeks ago. So take that into account. As far as the S&P, so far 240,000 contracts have traded, which is higher than the mode or the expected volume. So that's a first indication that we have relatively unusual activity. The thing is, it's still within one standard deviation, so this is normal, but it is elevated. The volume is elevated. The overnight inventory is 56% long, which means that 56% of the volume traded overnight has taken place above the prior settlement. So this positions the market relatively long by 56%. The range is outstanding. Again, we have pretty active price discovery in the S&P. The range is 52.5 points when we normally expect about 23 points. In the overnight session, 37 points is the edge of what we call normal. Anything above there gets into the second and third standard deviations, which get our attention, and 52.5 points is pushing upper 2 sigma in terms of range. So what does that say? That says that there's active price discovery. We should expect continued volatility into the open, and we are likely to see some opportunities for movement as the market opens. This is what this sheet is telling you as it stands right now. Yes, it's in real time. It shouldn't be, but it's just a pain to turn off the real-time feed on this. Just need a better method of doing that. But you are seeing the current prices. So what are we looking at in terms of what was expected yesterday versus what we got? Yesterday, the key areas of play that I pointed out. I'm not doing the scenarios because of the added volatility and the continuous activity by the OTF, meaning macro forces, bigger forces are in play. There's no sense playing scenarios because the short-term and intermediate time frame players are active. It's hard to predict what that is. Those players operate in 20, 30-point ranges rather than what we do, which is to look at rotations of 5 points or so currently. So the key areas are 55, 41, 30 below, 69, and then we have the standard stuff. So the overnight point of control, the overnight high, and then anything above there, the key number above is 44.16. 44.16 brings us back into balance after the sell-off on Monday, and that's the big area above. And then 44.80, actually, if we can get up here, we have some pretty strong resistance. But currently, coming into yesterday, the key areas we were looking at are the stock zones that you see above, with the major areas at 69, 55, and 41, as well as 30. So let's take a look at what we actually got in our review segment. So in our review segment, let's get rid of these stock zone lines. In our review segment, this is what we saw yesterday. Seems a little noisy, I know, but well, let's switch it to a 6-tick Renko so that we can cut down on the number of bars and we can expand, zigzag off. So yesterday we opened up, we poked up, doesn't look like much, but it was 2 points, dropped into 61, tested 76. Now remember this number, 76, and this here defines our opening swing low and high, and those are not relevant. These are not opening ranges. They're not relevant to time. They need to occur, the opening range needs to occur in the first bracket, which is the first 15 minutes or so. Beyond there, I don't consider the opening swing. But 76 important, 61 important. 61 is important because it was tapped 4 times before the rotation up, making it a weak low, So this becomes a key target for shorts later. Keep that in your back pocket to trade against later on. Pulls back to the RTH VWAP and pushes through the 76 to 85. 85, we see a lot of size come in. I saw a big battle up here at 85 in terms of volume coming through. And so the first trade that set up was 83.75 short, 83.75 short, put in a lower high, and now we've got risk cover, and we're looking to break through the 71 quarter, which was the prior day's high and the current day's open. So yesterday we opened right at the prior day's high at 71 and a quarter, and that becomes a big area for a pullback, for support on a pullback. If it breaks through, it'll act like resistance. So there's another opportunity of the short. And in this case, if this all sounds to you like a bunch of gibberish, good. I'm glad it does, because it's saying that this is stuff that you're not looking at, and there's an opportunity for you to expand the way you look at the market. But essentially, once it breaks through the mid and gives us a pullback to 71 and a quarter, this creates an additional opportunity for a short, and the short then targets 61, which is 10 points away for about a 3-point stop, giving us a 3R trade. Does that sound like military speak with all the acronyms and whatnot? So once we break the mid, we're looking for it to break below this week low. We target then the 50 becomes key. The 50 is the prior day's point of control, and traded heavily on the big rally, the 54-point rally we saw on Monday, and that becomes the next key target. Once that's taken care of, we look for settlement, which was just below the 50. The settlement was 48 and a quarter, 43, 48 and a quarter. These are numbers that you need to remember. And then the prior close, 3 p.m. close, 3 p.m. central close, or the cash close, which is now the official RTH close, is 46 and a half. And once we get to 46 and a half, the only thing we have left is the overnight low at 41. Poked the 41, and then I started to see support at 41, looking for a higher low, and there you have it, back into VWAP. My point being, rather than running through it piece by piece here, and I'm probably spending too much time here on this on the past, my point is there's quite a bit of structure here in the market. I'm finding that the market is trading with additional volatility, yes, and we've talked about this over the last couple of days, that with additional volatility, we have to keep our risk per trade the same. So we have to cut our size probably in half, increase our stop, increase our scale outs and targets to keep our R factor the same. But I'm telling you that this market is providing good structure to trade against. It is respecting day type levels, except that we have these weird sweeps and things like that, as if it's still rollover and expiration, and that's because the higher time frames positioning in and out and hedging and whatnot. But overall, this is I want to make a point that this market, if you get emotionally involved with it, this market will eat your lunch. And that's why I have a sticky note at the top of the live chat that reads, are you trading with risk limits? If not, why not? You should have broker imposed limits on daily losses, at least. Risk limits necessary. You need, in other words, risk limits are necessary per trade, per day, per week. You need to limit the amount that you're investing in each trade, in each day, and each week. And so that you can stop yourself from just getting emotionally involved and not being able to see that there's pretty good opportunity here. The thing is, the opportunity comes from volatility. Volatility heightens emotional response in traders. I've got tons of experience with this. Believe me, taken some gargantuan losses in trading over the years. But if you keep a cool head and just wait, you'll start to see that there's some pretty decent structures. And the thing I like about this market is you get stopped out quickly and you get paid quickly, if you're correct. So if you're wrong, you get stopped out quickly. It helps kind of level the playing field and bring you back to earth to kind of take on the next trade. So it's just be aware that with higher volatility, you're going to want to fight back. You're going to want to get that P&L back. You're going to want to do stuff to get your money back. This is not what it is. This is not the game here. The game here is to stay with the story as best as you can. That's easier said than done, but that's where the experience comes in. Stay with the story. What is it doing? Who's winning the daily fight? That's where our daily time framing comes in. Who's winning the open? Who's winning the intraday fight? How is the current action responding? Yesterday we had several points where the sellers were dominating the day. You could see that it's selling off lower highs. The peak that was put in later was a lower high too. So we expect to test the lower low, higher low, and you're getting this battle back and forth. The idea here is to just keep your wits about you so you can see these opportunities and respond to them. Okay. So anyway, not meaning to lecture you or soapbox you, but in general, we don't see, there are some good opportunities here, in my opinion. We don't see this all the time. I prefer this over 12-point range days. Right now, 12 points is what I would expect from any given trade versus an entire day's range. So this is the time to be on your game. And if you're not journaling what's going on, then you're probably repeating the same mistakes. At a minimum, print out a chart, your trading chart, your trigger chart, and just X in your exits and entries if your software doesn't already do that. So you could see where you interacted when you have a cool mind. You can see where you're interacted versus the overall picture. Here's where we are in the overnight session. We opened And then I was doing my homework when this big drop happened here, and then immediately came back. I scoured through my news feeds, and there was some chatter of Evergrande and whatnot. But I don't trade during that period, but I don't like that kind of news because we're putting too much weight on one event. I mean, we're pricing 500 stocks that are worth trillions of dollars based on some company in China or a single company in the US or whatever. We attribute a symptomatic or systemic consequence due to that one company, and I think it's overdone. But in any case, we ended up with a P-shaped profile overnight. This is a short covering type of action, short covering profile, which brings us where? It brings us right back in line with where we have been so far. And if I extend this profile, this composite that I've built here, based on a discussion we had at Convergent Trading during our trade talk, you can see that actually between Monday and Tuesday, all we have is balance. We have this massive balance with 4350 being the composite point of control. This is what's called a micro composite profile. And we have this just massive balance with a low volume node right here in the 35 zone all the way up into the 85 zone or 90 zone actually. And so we're trading in balance in a big kind of range, but we are actually in balance. Look at that yellow profile. I mean, this is a beautiful, almost Gaussian profile here, and we're in the middle of it, and we're opening in the middle of it. So the day before yesterday, the high in the RTH was 71 and a quarter. Yesterday, we opened right on 71 and a quarter, and we are currently trading in the region of 71 and a quarter. We're currently trading, what, 64? We're about a rotation and a half away from 71 and a quarter. This market looks like it's rallying and all that, but if you step back and look at the profile for the whole area, the conclusion that you have in front of you is that the market's imbalanced. So don't have these big expectations. I expect it to have good volatility due to the range and volume it has traded, but don't sit here and think, oh, this is a rally day, I need to find a long, because really all it's done is it pulled us back into the major balance that we were in yesterday and just above the balance over the last few days combined. Okay, so that's what we've got. We've got positive delta today. Yesterday delta was flat. And then looking at the bigger picture, let's clean this chart up. Looking at the bigger picture, the biggest area of interest to me remains the 55 right in here. The 55 right in here. You see these bottoms? This 55 remains kind of the over-under line, with the 50 being the point of control. So this is the magnet right now. The 50 below us is a magnet. So don't be shocked if we open up this morning and we make a run towards that 50 again like we did yesterday. It's a big magnet area. We've seen a lot of volume there. It's a mid-century figure, big strike price, blah, 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 blah. So that's what we've got. Let's take a look at what's expected for today, and we can all go on about our business. So given that we are in balance and moving back into a more, I don't want to say controlled, but more constrained type of, are you guys hearing me? Test 1, 2, 3. Did I lose you? Did I lose you all? Hit a refresh. Not sure what the issue is. Doesn't look like I'm dropping frames. In any case, given the map, I'm expecting an open that drops us back into the 55.50 area, consolidate. I'm looking for the market. Yesterday, we pushed a higher low and a higher high against Monday. I'm looking for this. That was considered a flagging arrest day. I'm looking for the 65 to 55 area to be strongly tested. I'm looking for the overnight high to be taken out. We have a weak overnight high. The overnight high at 73.75. I'm looking for a push to 83.85 before the FOMC. Once the FOMC is here, no idea what this thing will do. Could go up, could go down. Who knows? It's anybody's guess. That's your first scenario. The second scenario, so I'm looking for a response to balance on the open. Per scenario one, I'm looking for that to be a base for us to turn around and push the 83.85. The second scenario is the opposite. We squeeze the overnight high at 74, push towards 83, consolidate back into towards the 55 area, and then sit here as if to stalk lower prices into the FOMC. Again, no idea what will happen at the FOMC, but I'm going to keep my hands off the mouse for the first 10 minutes or so, not 15, but 10 minutes or so, to see who's in control, what the key tests are, and how those tests are then treated. And then the break of those tests will help inform which side I'm looking to push. So compare the open with the opening swing high, opening swing low, and see what quality tests we get. And then we'll know very quickly, is it aiming for 83.85 into 92 potentially, or is it pushing down into 55 and then back into balance at 50? We need to see what happens there before we take a position, in my opinion. That's what we're looking for. While you're here and while I have you, take a moment to find the subscribe and like button. Please hit those every time you're here. If you have not, hit the like button every time you're here. If you're not subscribed to the channel, I appreciate you subscribing. It promotes the channel and it makes it easier for other people to find this feed when they're looking for videos relating to futures trading. I'm sharing with you what I've done for years and years and years, and what I learned from being a prop shop owner and backer of traders. This is different than the guys who show a live screen and just do random trades for big wins or losses. My goal is to help you trade professionally. That's what I'm here for. That's what convergent trading's here for. That's what EdgeClear's here for. This is a mission to have an impact, positive impact on your life. Please subscribe, like, share with friends. Take care.